Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Right now, we're going to get right to it. We've got a wonderful conversation here. What Oliver Wyman has done as part of Marsh McLennan and Mercer and all the rest is it gone out to people that have shown stunning expertise in different fields, pooled them in together, and it's like a legit global consultancy. So to explain, it's like Butch Cassidy. Who are these guys? Dan Tannebaum is sanctions. He's the one that knows who's cheating and why they're cheating and what's going to take the will, if you will, for, in the case of Russia, for Europe to get its act together. Huw van Steenis was iconic at Morgan Stanley ages ago on finance and banking worldwide. Huw van Steenis is partner, vice chair at Oliver Wyman, Daniel Tannebaum, partner, global anti-financial crime practice leader at Oliver Wyman. Huw, let me start with you. The year end, it's not like 30 pages. The 120-page Oliver Wyman, this is 2026. Do you have a theme yet?
It's a great question. Well, look, so I was just chatting with one of my friends about their outlook yesterday, and they said the biggest question for them was, has the flurry of defaults, is that going to be a snowstorm, or is it going to be, that was just a little flurry which came past us? So I think the credit markets, spreads are historically tight, risk rewards are a little bit tighter than it was. Where do credit markets go from here? And is there how much of a slowdown? I think that's one of the big questions on our clients' minds. Obviously, the whole AI data center growth, will that impetus offset? That's clearly baked in and a big debate too, but lots around credit markets.
But when you darkened the door to Oxford, did you take cockroach 402? I mean, are the cockroaches out there?
Yeah, we don't get so many cockroaches in the UK.
A little chilly there.
But in private credit, this is a germane question for banking and for everybody out there. Are there going to, do you sense this as cockroaches?
Look, the way I take it is this feels like a bit late cycle behavior. So, imagine we're a long way through a cycle. Some of what we see, and you see on Bloomberg this morning, is fraud. Some is difficulties around a K-shaped economy. What the real dissonance, Tom, is that the bank CFOs we engage with are not sensing a big pickup in credit. They're saying it's really benign. But obviously, what the debate in the market is much more concerned. So I think there's a real tension there. At the moment, I don't see. This late cycle, there will be more defaults. The key question is, are they well spread, and what are they amplified?
Dan, what's the latest here on, I guess just our tariff policy here in the U.S.? The Supreme Court heard some arguments last week. I guess we'll hear from them later this year here. But what's the policy these days on tariffs? Is there one?
Well, the policy is the Trump administration is treating that hearing like it's a speed bump, if at all.
Okay.
Really trying to come out saying we have other authorities we can use, whether it's Section 232 or 301, which are much more limited than what the president attempted under IEEPA, which is a reminder, IEEPA was created to limit the president's authority. So all of the rhetoric that Trump had said around tariffs in the run-up to and aftermath of Liberation Day kind of shot the whole argument in the foot. And it's why even the conservative justices were pretty skeptical of the arguments made. So I think the administration is trying to show confidence that their strategy will move forward.
Do you believe in that? Bessent's over with Morning Joe right now talking it up. The basic zeitgeist Paul's talking about is we've moved on from tariffs. I don't buy it for a minute.
We've definitely not moved on from tariffs, because if we do, that's a key part of this administration's strategy for hammering out trade deals. So it literally kicks the stool out from under a bunch of them. And you look at what's happening between the U.S. and China, where there's this détente for the moment. Does that go away? Does China begin to turn the screws again and turn off the spigot for the 5 rare earths they began allowing movement of?
So, Huw, part of the talk of this administration has been really impacting your industry, the financial services industry, in terms of deregulation. Is that a thing, or they've been focusing so much on tariffs they haven't looked at the banking system?
I think that the simplification of bank rules is one of the 4 big priorities for the administration. I think that funding the data center build out, the energy security, the rare earths supply chains. Think about the JP Morgan announcement about national security. Huge numbers for the next decade. So no, I think that financial deregulation, financial simplification, as I think the industry is calling it, is a huge part of this. And I think what we're seeing here, think about the data center, it's all hands on deck. Yeah. The banks alone can't do it. Private markets alone clearly can't do it. So you need both working together. I think that does mean that the banks are feeling, a bit of a spring in their step. Certainly the larger ones, because of the and the key question will be how much of it comes back in buybacks and dividends versus actually really reinvested. And that's the bet here.
Special moment here this morning. Daniel Tannebaum and Huw van Steenis there with Oliver Wyman together with us in the studio. I want to go holistic on you. I mentioned yesterday Apple TV down Cemetery Road. It's like a travel log for Oxford. Okay. Basically, it's centered in Oxford, and they use the Bloomberg terminal great within it. Nice. I mean, I was looking for you, Paul. I didn't see you there, but down Cemetery Road's doing the Bloomberg thing. You saw Huw van Steenis in Slow Horses, like season 3. He made an appearance. I want you guys to talk about Great Britain. And as a general sense, Dan, you're as the ugly American foreigner. Huw, you're living at your service to the public of the United Kingdom. From where we sit, it's turned upside down. Kit Jukes at SocGen this morning with a blistering note. Jordan Rochester models south of 130. Huw van Steenis, where is your nation in 12 months?
Look, it's a great question. Look, when we would have these debates, say 15 years ago, the UK was mid-Atlantic. We had the growth rate, which was mid-Atlantic. We had the deregulation, which was edging between the two continents. And I think post the financial crisis, and particularly Brexit, the moment we voted to leave, the more European we became. And I think that's the challenge. Brilliant. And that's the problem here. The politics has become more unstable in Italy's. The finances have become a little bit more unstable. Right. And I think the debate here is like, will the pressure from the bond markets edge us back to that mid-Atlanticism, or we just got stuck in a bit of a rut? And I think, look, politically it's painful. But like everything in life, it's not all about politics. There's some good stuff on the economies too.
You're expert on Heathrow and the tram and sanctions and all that. You sat in the truck lines at the port of Dover. Is the relationship with the United Kingdom and the continent of Europe, is it basically shattered because of Brexit?
I'm not sure I would agree with that. I mean, Huw is certainly the expert on this, but is it shattered because of Brexit? I mean, interestingly, in my world, and I've been in Brussels and London in the last few weeks. If you take the issue of Russia, I think there's general alignment between the European Commission, the British, the US, which is nice to see for a change. So, I mean, I think it may be on an episodic basis, but shattered seems like a stretch.
So they're getting on. They're getting along.
I think so. Do you?
Well, just go back to finance. It's interesting. I think it's interesting how two big private market firms have both, Brookfield and Apollo, both bought in the UK recently. So there's money to be made in terms of financing. The economy may not be leaping ahead, but there's business to be done.
Can I? And Paul's got like 8 questions here. Huw van Steenis, Dan Tannebaum with this. All my radar is up, and I'm biased, saying go long United Kingdom. It's so gloomy. Exactly. Like, what's the royal family going to do? What in God's name is Tottenham going to do, tying Man U late in the game? I mean, my gut feeling is this is the time to go long Brexit, long UK. Is that in the Oliver Wyman zeitgeist?
Oh, look, I think it's an interesting call. I mean, the moment where you get the pessimism about the UK, particularly on my trip here to the US, is profound. So I think you're right that I think it is kind of darkest before dawn. I think the pressure from the bond market is going to challenge the government to make better fiscal decisions. Look, there's a little bit of caution, but I see a lot of interest around. You talked about Oxford, around the universities. There's a huge science parks being built. The Ellison Institute has just poured in over 100 million into Oxford. I think there's a lot of excitement around science and energy. But I think it's most important to invest through the politics, not because of.
So, Daniel, talk to us. You mentioned some of the sanctions on Russia and so on. Talk to us about sanctions. Do they work at all here? Because it just seems we have wave after wave after wave of sanctions. And these people, I think it doesn't seem to have an impact. I don't know.
So there was a moment a few weeks ago when the U.S. decided to rejoin the global coalition and sanction Lukoil and Rosneft. And those were literally the first sanctions that the Trump administration has put on Russia since they took office in January. I mean, they have made a difference because they, in doing so, put India and China on notice that if you continue to buy, you may have issues. Now, follow through is not necessarily a strength of this administration on this issue, but you have seen a reduction in barrels per day being sold. It is beginning to hit the Russian economy. But when you look at things like, Orban coming to the White House asking for an exemption, depending on who you ask, indefinite or a year, like that kind of doesn't help the argument necessarily, but they are moving the needle. The Biden administration was very reluctant to touch energy, probably too reluctant. The Trump administration has waited way too long to re-engage, but now that they have to follow through and actually enforce the existing sanctions.
I've got a project right now, John le Carré, the iconic British author. I'm reading each of his books, trying to go back and get a first edition, having a hell of a good time. I'm on the Looking Glass War right now, right after Spio came in from the cold. What's the Russian relationship with the continent? Not so much in terms of MI5 and spying, but what's the Russian relationship commercially with Europe right now that we don't see?
There's still trade. There's trade for nuclear fuel, things like uranium. There's still LNG that they're weaning off. I think January 127 was the date they pushed forward in the last round of sanctions that the European Commission passed. There is still trade. Like, it is not dead. And the challenge is there's still a lot of goods that are transshipped over land borders into Russia. We have an automotive client that will go nameless that saw like a 200% increase in cars being sold to a country bordering Russia and said that with out irony. It's like you see what is happening here. Like, the cars are being shipped across the border. Countries like Latvia have actually stepped up their efforts to literally block physical movement of goods from Europe into Russia. But there is still trade. It is not down to nothing. Like that much is clear.
Two great skill sets at Oliver Wyman, Huw van Steenis with his vice chair, and Daniel Tannebaum, partner here today on sanctions, and Hugh's just great financial expertise as well. Paul Sweeney, Worldwide with Huw van Steenis and Dan Tannebaum.
Huw, with some hindsight here, how does the average Briton view Brexit these days? And is it still a talking point? Does it come up in a pub on a Friday evening?
So there's two answers to this. If you look at the polls, there is some buyer's remorse. So the majority of the population now have regret. But I think this is more like thinking ahead to Thanksgiving about what are the topics which shouldn't come up around the dining table.
So it's still
there's still one of these topics which people put below the table until the fourth glass of wine.
You're hugely qualified on this. Huw van Steenis, should the Fed enjoy the dissent of the Bank of England? Bank of England recently 5-4. Unheard of at the Fed. We would never see that. And working with Governor Carney, now running a small nation to the north, Montreal Canadiens in first place, I believe. Huw van Steenis, just as simple as I can, the dissent that we've learned at the Bank of England, is that a constructive exercise?
That's a really good question. I think it speaks to just how difficult the setup is, because you've got sluggish growth, as you've just said, Tom. So you want low rates, but inflation keeps picking up ahead. And that's partly actually a function of Brexit, but it's partly a function of other import markets as well. So I can see why the committee is really stuck and challenged. I don't think you'll get quite the same degree of dissent over here because you don't have the same difference in fundamentals. But I think it's sort of healthy, but it probably speaks to the problem rather than the committee.
People are really begging for that to a great extent. One final question, Dan Tannebaum, you are hardwired in to the bonus joy of autumnal 2025 global Wall Street. It's nuts out there. I mean, it's a boom Wall Street economy. Exactly how much is the real estate of greater New York going to explode higher here with all that money coming in to New York Wall Street?
I don't know where you're going with this one. I mean, I do.
Come on. How much is the Hamptons going to go up? Springing into
Hamptons has seen record price increases.
That's what we want to hear.
So I don't know if that means people are migrating east on a permanent basis or if people have just rediscovered the beauty of the Hamptons in the off season.
But with your experience, it's a boom Wall Street economy, right?
It does seem that. But, I mean, what does it take to flip it the other way? Like, if the Supreme Court rules against the tariffs, for instance, how does the market react to that? They've been pretty muted to some of these broader events and what that.
Do you have a call on what the Supreme Court's going to do? Michael Barr needs to make some news.
I'm not on Cauchy or Poly market, but I feel pretty reasonably comfortable that they're going to overturn and uphold the prior decisions that the IEEPA tariffs are shot.
Huw, last word. Is the city enjoying the Wall Street boom that we see in New York?
Nowhere near as much, no. And I think actually we've obviously got concerns about housing taxes about to come through in 2 weeks' time. So the housing market, you get a bargain. In fact, the number of Americans, Tom, when you're coming over to buy your John le Carre's, you can pick up a house at the same time.
It's just. I read the Telegraph. I read the Times. I read an article on the BBC yesterday in the Times of London. It was incomprehensible. I couldn't understand it. I literally tried to understand what's going on there. It's nuts over there. Is everybody going to leave if they put through this tax regime?
So we've already seen a significant wave of non-DOMs, in other words, non-Brits who had a special tax status. And if I go to events in Milan or Middle East, there's plenty of folk who've departed. And it's a bit like the debate you've had recently in New York. The tax base is very geared towards the top 1%. So we've already seen a stream of people leave. I think though now these taxes are more for middle classes, and that's going to be tougher. But you're also seeing some of the young, the under 25s move too. So I don't think this is 1970s. It's nowhere near like that. But that's the comparable. But it's definitely getting. This is the topic of the dinner tables.
Dan, one final question: are you moving to Milan?
No, I'm staying. We just finished a long overdue renovation. I am long in New York, regardless of what's happened in the last week. So I'm not going anywhere. Dan
Tannebaum, thank you so much. With Oliver Wyman, Huw van Steenis, thank you for visiting from the United Kingdom. Van Steenis and Tannebaum of Oliver Wyman together. Love doing that here. The conversation is what we try to do with these two gentlemen of great expertise in sanctions and, of course, in European and global finance. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Government shutdown. Let's do economics.
Yeah.
Blerina Uruci joins us now, Chief U.S. Economist at T. Rowe Price, as we get the market open today. Blerina, how blind are you at T. Rowe Price? When you go to a meeting with Sebastian Page and the other beasts, where are you getting your information from, your belief, your conviction?
Lucky for me, Bloomberg published this alternative data charts and tables and so on. So I'm not flying so blind anymore. Also lucky for me, we are a big fundamentals house with bottoms-up analysis from our credit and equity analysts. So we're getting a lot of live information. It's just the job has become harder because we're not relying on the same things that we used to feed the models in the past. But what your question is, what are the private sector data telling us? We had seen some encouraging news from ADP that weakness in labor demand was stabilizing in October and that we could hope for improvements going forward. The ISM employment indices were pointing in the same direction. So I think I'm still leaning on that as my thesis. But today's weekly data on ADP, which showed a decline for the week of October 25, was a bit of a setback. Now, when I'm talking to investors and Sebastian Page, what I'm emphasizing is that October will be really noisy. It will be activity, spending, employment numbers will be affected by the government shutdown. We might not even have visibility into price data because it's too late to collect CPI data anymore. But we'll look at November, we'll look at December to gauge the trend of the economy. I remain still optimistic about the path going forward, and we can discuss together why that is.
So, Blerina, do you have a sense of if the government does open in the next few days, how it will release the data to the marketplace? Do you have any sense of when that will occur, how that will occur?
Right. This is a very important question right now, because essentially what we want to know is how much information will the Fed have before its December 10th meeting. So let's see if the government opens later this week. I expect that both BLS, Census, BEA, they will all release a new data schedule once they have gauged how much time it will take them to play catch up. I think we should get pretty quickly the September employment report, because that would have been already prepared before the government shut down. It was a matter of formality to approve it. Now, the BLS could go down the route of collecting October and November employment data, and that could delay the release of the next employment report. Or if they just focus on November, it's a data collection week this week and next week, so we could see that before the FOMC meeting. And I think that would be quite important for the Fed, because they won't have the CPI report, but at least they would look at the full employment side of their mandate before the next meeting.
Unbelievable. I have no idea how we get to the December meeting. We're going to continue with Blerina Uruci, Chief U.S. Economist at Rowe Price. Give us a moment here to get the market open. Again, the bond market is closed today. There's a little bit of, spread information in that, but it's dated and frozen here in the bond market. The equity market not frozen, with red and green on the screen to keep score at home going into the market opening. Futures are negative 15 to see where we end up here. But with red and green on the screen, an interesting Veterans Day. The dollar resilient. Here's Lisa Mateo.
You got it. And let's start right now with the S&P 500. Right now, I'm seeing some red on the screen, down about 0.2%, 14 points. The level, 6,817. We go to the Dow, it's up about 0.1%, 70 points, 47,444. And the NASDAQ right now, down about 0.5%, 118 points at 23,407. The yield space, well, we have the bond market closed today, so we're not going to get that. That'll be back open tomorrow. Over to commodities, we have COMEX gold up about 0.3%, 4,137 an ounce. Brent crude up more than 1%, $64 a barrel. WTI crude $60 a barrel. The Bloomberg Dollar Spot Index down about 0.1%. Checking in with shares of NVIDIA at the open, they're down about 2%. That is your Bloomberg opening bell report. Paul and Tom.
Lisa, thank you so much. First quote here on the Dow, up 108 points, but it's sort of a mess out there. We'll see as we go forward. With this, Blerina Uruci, Chief U.S. Economist at Rowe Price. Blerina, I mean, what is it? It's November 11th, right?
Sure, yeah.
We know that date. Okay, so 1 week out, 2 weeks out, 3 weeks out. How do you prosecute a Fed meeting? I mean, I get it. It's original territory, but how original will it be in December?
I think it will be pretty tough, this meeting. We know the committee is already quite divided between cut in December and staying put, because they're worried about employment on the one side and inflationary pressures on the other side. And I feel like because we don't have new data and information, it will take that much more to shift either hawks or doves from their position. So it could be quite a hot and contested meeting. What do they need to see? The thing is, October, first month of the quarter, we know that the spending data and activity data will be affected by the government shutdown. The CBO estimates 750,000 furloughed workers from federal government. That's 0.4 of a percentage point effect on the unemployment rate. That could show up in the unemployment numbers. Now, the FOMC needs to figure out whether that's noise or whether it's continued weakness from the summer months. So it's going to be pretty tough. And on top of that, they won't have the information they need on the price side to say, okay, there is some softness in the labor market, but we have some uptick in inflation. So those two things might cancel themselves out. So it's going to be a pretty difficult meeting, I think, to navigate.
And here's the key thing, Paul, if they're blind on price, all they've got left is the price of the market, which is yield. Do they make a Fed decision off the 2-year Sweeney yield? I don't know.
I don't know. So, Blerina, what do you think is the focus of this Fed here coming up on their December 10th meeting here? Inflation, employment. What's taking center stage, do you believe?
I feel that we're still on the tail end of the full employment concerns. It feels a bit like 2024, when they were worried about the labor market rolling over quickly and they were worried about activity. I get a taste of that situation right now too. So we are at the tail end of them focusing on full employment. I think next year, and perhaps even as soon as after the December FOMC meeting, the shift will be towards inflation, because I do expect that we see those effects of the tariffs picking up in Q4. I also think the dollar weakness since the beginning of the year will push up import prices. Also in January, we're going to get that price reset that we've seen since the pandemic. A lot of companies will reset prices at the beginning of the year. And so I do think the focus will shift to inflation, but we're not there yet.
Blerina, thank you so much. Great brief here at a tough time for economists. Blerina Uruci's with T. Rowe Price. Stay with us. More from Bloomberg Surveillance coming up after this.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
John Stoltzfus gives us a clinic here. He's with Oppenheimer and a company, their chief investment officer. The greatest thing about your notes, John, is you address the fear. Is this a repeat of the late 90s, the dot-com bubble? We do not believe so. Discuss.
Well, Tom, great to be here with you today. I've got to say that we do not think that this is the tech bubble at all. And it's a very different, the structure is decidedly different. I remember exactly where I was during the tech bubble. I was fortunate that time I was manager of international equity marketing. So I was working with privatized telephonies, all kinds of things around in Europe and Latin America. And I was pretty clear of the tech bubble, but I watched it happen because I was very much in close proximity. At that time, tech was rather primitive if we look back on it. I mean, we had the modems that we'd plug into the wall. And the frozen screens that would occur even at the well-known firms around town. Your best friend was the tech person all the time because you'd get free.
We call him P. Sweeney.
And today what we have is...
Did you buy a lunch in 1999?
Never, please.
Okay.
Never.
Right?
Yeah.
The marvels when you'd hear the cart come down the hallway, I'd start barking, and I'd say, make sure I have the cheesecake with the caramel frosting on it. But where we are today, I think, is structurally, technology is deeply embedded in the lives of both the consumer as well as business. We're all on the upgrade cycle, whether we like it or not. And these big companies are highly profitable. In the world of positive cash flow and developments, if anything, probably the biggest risk is that governments around the world might want to break them up. And at this point, even that probably wouldn't be so bad because probably the individual pieces are worth more than the sum of the parts. So I think it's a different world.
John, we're pretty much through earnings season. It seemed to be pretty solid earnings. Is it enough to support this marketplace, do you think?
Let me tell you that I've got to say, Paul, the earnings are just marvelous this time around when you consider that 9 sectors are positive. Of those, 5 are double-digit growth, and it's a mix of what you would call value as well as growth. So you've got tech right in there, but you've also got good representation. Even materials is doing fairly well right now with the earnings growth. You've got positive there. So when we look at it, if anything, we think the rally has broadened, but it's still driven by technology because technology like credit makes the world go around when it comes to finance. And the market, I really believe, no matter what the turbulence is in Washington or Beijing or Moscow, ultimately what they're really caring about is revenue growth and profit growth. And we've got it.
We start strong this morning. John Stoltzfus, Oppenheimer and Company with us. Good morning to New York, down to Washington, 99.1 FM. Good morning on Sirius XM, channel 121. I have no idea how large that audience is.
No.
It's like old technology.
Sure,
and
absolutely.
It's still rocking it.
Yeah, I know.
Across Canada as well. Paul Sweeney with John Stoltzfus.
Hey, John, so, one of the concerns in this marketplace is AI. It's been such a big theme in this marketplace for the last 2+ years, not just in the technology sector, but just kind of across the market in general. Are you concerned that, we're in an AI bubble maybe for some of these sectors?
Paul, I really think where the bubbles may be found are probably in the areas of meme stocks and cryptos. But when it comes to AI, when we talk to people, whether it is private investors, just general consumers looking for things. Civilians are using AI more and more all the time. And within business, I can remember a few months ago, I attended an institutional audience conference here at Bloomberg, and it was a mix of people. It wasn't just people from finance, but it was healthcare and different sectors, and everybody was on it. Normal people, and they were. And I met a person from healthcare who said, "Oh, how she loves doing research with AI because it makes her so much more efficient." And then at one point she said, "Sometimes I think it's better than me," and I said, "Shh, don't say that," because I think the other thing is I don't think AI is going to replace humanity because it has no it has no sympathy or empathy, and it's apart from human.
Where are you? 7,000 on SPX?
7,100.
Just killing me. Can we make some news here? Lisa, give him a Tito's and Tang. Come on, can we get to 7,200?
I think that 7,100 could be surpassed, but I'm sticking with the 71 at this point. It's pretty late in the year.
The Gloom Crew, the foundational discussion is the earnings juggernaut, the cash flow juggernaut will end. Do you see it ending for the chosen few, or does it continue to disperse to a better earnings season for all the other stocks?
I think, at this point, I think we begin to see, this earnings season, look what we've got. Earnings growth up 11.7% on back of 8.1% revenue growth. You've got tech, 24% growth year over year, financial Q3. Year over year, 23.9. So that's another 24 piece. You've got materials, double-digit growth, industrials, double-digit growth. This is looking pretty good, and the single digits aren't bad. And you've only got two sectors with negative growth. That's energy, negative 2.26% on the screen, and communication services, 8.19%. And that some of that may be the result of just incredible investment at a watershed period related to AI technology.
So where do we go from here, John? We've had a crazy year, excellent returns so far after that volatility in the beginning of the year. How are you positioning 2026?
Well, right now, we won't make our official calls until mid-December when we usually do, because we don't have X-ray vision like
That's
Superman.
When you'll go to 7,200.
I like that.
I'm trying, Lisa. Lisa, I'm trying.
Kind of clouds the situation there. But what we would say is we probably where we're standing, not in terms of the index itself, but for years now we have been cyclicals over defensives. So emphasis on cyclicals, and primarily large caps, but with a smattering of always hope for the mids and the smalls. But I think until the Fed really cuts rates, I don't think they're going to get much love.
Are we at a point where I'll take the juggernaut, and Dan Ives says Microsoft is the foundation to this dialogue. Is Microsoft a cyclical in nature? Well, it's a really philosophical question. For Warren Buffett, he's 95. He's going quiet.
Yes.
Stoltzfus won't shut up. That's the opposite of Buffett. The bottom line is some of these tech stocks have almost cyclical characteristics.
We most certainly think so. And in fact, in the old days, back when we used to call consumer staples a defensive sector, Coke, smokes, and soaps, technology was regarded as a cyclical, and we regard it as a cyclical because while the investment appears to be a secular issue and the developments are, the actual investment is there's sentiment behind that, even at the institutional level in terms of Palo Alto.
John, how much does this market need the Fed to continue to cut rates here?
Good question.
We have been for the last few years, the last 2 years, when a lot of people were expecting a lot more cuts, expecting that Jerome Powell would be very careful with cutting rates. We were looking for this year maximum of 3 cuts, and then it looked for a while it was only going to be 2 cuts. But I think we're going to do. I think he will do another cut of 25 bips in December.
Okay.
And the big thing is the Fed is very, very sensitive as to how it practices its dual mandate. And the dual mandate being supporting the economy.
Brilliant question.
and
I mean,
labor.
Paul, you're too young to remember this. Stoltzfus and I remember Arthur Burns, and he'd have a pipe, and you go, he's making circles with his pipe smoke. What's it mean?
What's that?
What do you think of the modern complete fixation on the Fed? I mean, we've gone from Marty Zweig, don't fight the Fed, to a 24/7 fixation on the Fed. And to your glory, you look at earnings, you look at cash flow, you look at revenue growth. Do we do too much Fed?
No, I think it's important to look at the Fed. If anything, in our research, which is fundamentally driven, it's revenue and earnings growth, but very much an eye to Fed policy. And we think we are living with the benefit of what I call the Ben Bernanke legacy, because Arthur Burns was a disaster. Then, as a result of that, you had Paul Volcker had to come in and take draconian measures. Remember, just about when I came in '83, just about a year and a half, 2 years before I got in, the yield on the 10-year almost reached 16%. That was real wild inflation. The current generation thinks that 9.7 was a lot in March of 22. But that Ben Bernanke legacy, high transparency, communications, it carries on through Jerome Powell. And that balance where you want to see the Fed nurture a sustainable growth in economic growth, but at the same time not overthrow the apple cart in terms of employment and jobs, and avoid a recession, which they have done, notwithstanding all the predictions of recession since 2022. So far, no recession, which I think is extraordinary.
John, what we don't talk about these days is tariffs and the impact on the economy. Is that kind of in our rear view, do you think?
I belong to the camp that, I wish they hadn't gone on that tariff route. Though when I look at it as a strategist, I think as a tactical maneuver, it sure got the attention of all the countries around the world. Yeah. Because in essence, over the course of the last 80 years since World War II, the U.S. had a policy where we exported our manufacturing.
John Stoltzfus, thank you so much. Just a brilliant dissertation there on SPX, the path to 7,100. Stay with us. More from Bloomberg Surveillance coming up after this.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Time for the newspapers here. Are we iguana-free in the newspapers?
We are iguana-free.
Okay.
I'm staying away.
What do you got, Lisa?
All right, I'm starting with the Wall Street Journal. I'm not sure if you noticed, but luxury hotels, they're charging this record high premium, okay? More than usual, but it's not stopping those affluent travelers from splurging, okay? So they had some data that showed that the average daily room rate at U.S. luxury hotel, a record high $394 this year. That's the average, okay? Wow. But when you look at, like, say, Paris, where a luxury room will run about $1,000 a night, the average price of most expensive ones about $2,600 a night. New York, you have ultra luxury hotels at about $1,500, some $2,000 a night. But still, bookings for those properties were up 2.5% this year through September. A lot of those luxury hotels are expanding too, so the prices are going up, but people are still splurging.
Anthony Capuano, Marriott, has said this repeatedly.
Yep. Yes, yes.
They completely underestimated the luxury hotel drive.
See?
I mean, there it is. I know in Paris, we've got offspring over there, and basically I have a secret hotel that's within this, the circle of tourism and all that. But I have a secret hotel that I tell no one about. I'm so afraid
exactly
of people.
That's a K-shaped economy.
Yeah.
K-shaped economy. Yep. Crazy.
Not good. Okay, this one I want to stick with the ultra rich, okay?
There we go.
There they go. They are scooping up penthouses in Dubai.
Really?
It's one of the world's hottest property markets right now. They're paying top dollar for places that are not even built yet, okay? This is bidding wars at Brookfield Properties' new luxury project in Dubai. Prices, okay, here it is, for waterfront apartments pushing above $24 million.
They have water there?
Waterfront. Yes, they do. They do.
All right.
So house hunters, they have to prove they have the cash. So in order to even
All right,
express,
I got it now.
Yes, in order to express interest, you have to hand over a check for $272,000 just to say that you're interested.
Wow.
Because they have so many people lined up, so they want to make sure that you have the cash and you're not wasting their time by checking these out. But more luxury hotels sold in Dubai in recent quarters than any other city. That includes New York and that includes London too. So it is the hot.
It is. I mean, I hear about this as much as I hear about Miami, or even more now. It seems like Dubai is just kind of like the hot place.
Yeah,
certainly.
But
for
the pictures
Europeans.
are beautiful. I mean,
yeah, it's awesome.
But if you have 24 million, then that's where
Persian
you
I
Golf.
used to go all the time. A major shout out to Peter Grower, our chairman, who really forcefully led the build out of Dubai. And I was there right at the beginning of it. And, they had a slope period. And I look up, I'm like, look at all the cranes on the buildings. Yeah. And our economic leader in Dubai said, Tom, the cranes are there because it's so slow, they have no place to put the cranes. So it's boom and bust. Yeah. And right now it's a huge boom. I mean, it's just huge boom. To say in Abu Dhabi as well.
All right, let's go.
Next,
remote broadcast.
Okay, this one. If you're looking to live a bit longer, you might want to extend your daily walk. Okay, this was in the Washington Post. Okay, it's a years-long study. See, I knew it. So you have to walk for at least 10 to 15 minutes straight. That's better for you than doing 5 minutes here, 5 minutes there, walk to the store across the street. That doesn't count. You got to do 10 to 15 minutes at
Lisa
one time.
An office wife? This sounds like verbatim what I hear.
Exactly. Walk to Penn Station. That'll get it done.
Is a Peloton a 10 to 15 minutes equivalent?
Oh yeah, big time.
You could do a lot.
Yeah.
I'm not going to go into the weighted vest because we've been there already.
Karen does a weighted vest. Yep.
Do you do? How many steps do you need to do to be Lisa Mateo healthy? Don't tell me it's 10,000.
10,000.
Plus. Oh no, not even.
Who's
That's
got
just
the time. How many do you need? Seriously.
I don't know. Well, Lisa's
I
every
do probably
day.
about
10 to 15
8,000,
2,000?
I catch up on the
500?
weekend. That's how it works. But yeah, they usually say 10,000.
But Lisa's a weights person. She's like pumping iron.
So you have to do
Newspapers,
football.
thank you so much. Lisa, go back to your breakfast.
Thank
Lisa
you.
Mateo, thank you so much with the newspapers.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.